Again, ladies and gentlemen, my name is Robert Ramos, and let us start with this UCP exam review. Good luck. Let's begin with Module 1, which are the fundamentals of investments and investments and trust basics. So, what are investments? How are investments defined? According to the dictionary, investments are the action or process of investing money for profit or material results. Economics, it's purchase of goods that are not consumed today, but are used in the future to create wealth. And for finance, the definition used there is that it's a monetary asset purchased with the idea that the asset will provide income in the future or will later be sold at a higher price for profit. So, in sum, investing is the act of purchasing a future cash flow. When you invest, you acquire assets which are expected to generate future income or appreciate in value or provide cash flows. So you commit a sum of money for a period of time when you make investments. You take into consideration inflation, time, or a risk of uncertainty. And at the same time, you expect that you will either get interest on dividends, capital gains, maturities, and sale proceeds. What makes an investment risky? Effectively, during this particular period, are you sure that you will get the cash payments? All of these factors, time, inflation, risk of uncertainty. You know what happens if you invest and you think that you're investing for a rate of 5 or 6% for 5 years? Right now, that's a good rate. That's a good rate of return. But after 1 or 2 years, if inflation skyrockets, then 5 or 6 is not a good return. You would have expected that the return should have at least increased by 100 or 200 basis points. So there's a lot of uncertainty. What is the risk and reward rule when making investments? Simply put, the potential for higher income is always accompanied by the higher probabilities of loss. So looking at this, your x-axis is your risk and your y-axis is your return. The thought process is generally the higher the risk, the higher the potential return. So why do capital markets exist? Intermediaries actually bring people together. The financial markets bring the borrowers, which include the companies, the governments, who are going to use these funds for long-term projects, and they bring the savers together. The savers include people like you and me who are looking for investments. So every time we ask savers, what is your primary goal in investing? These are the questions that we have to ask them. So, what is your primary goal in investing? Is it to preserve the entire principal with income, higher slightly than TD rates? Is it to generate growth? Is it to aggressively grow the principal? What is your investment horizon? Is it 1 year? Is it 1 to 5 years, relatively medium term? Is it long term? How important is liquidity with the funds that you are investing? Do you have other sources of income? Thus, you are highly dependent on liquidity, or you have other resources and you can stay invested in the medium term, meaning 1 to 5 years. Or you can say, I do not need the funds, I do not need it right now for 5 to 10 years. You can do with it as you will. What is the risk appetite with regard to investments? Can they accept investment losses? Are they able to accept an average degree of risk in exchange for, better returns, at least in the medium term? Are they able to accept substantial amount of risk for potentially higher returns over the long term? And what is their experience and knowledge with regard to investments? Is it limited? Is it adequate? Do they have at least 1 year of investment experience? Or do they have extensive experience in investments, such as, more than 5 years? Are they familiar with structured funds and the like, and even derivatives? So, what are asset classes? Asset classes are a collection of various securities that exhibit similar traits. and they respond in the same way to market fluctuations. What are different types of asset classes? You have cash and money market instruments. This offer the highest level of liquidity. You have fixed income, bonds, government securities. They effectively are proof that you are lending money to a borrower or lending money to a company or a government. Equity, which connotes ownership into that company you are buying into. And you also have alternative assets, ownership of a physical space, an item. It can be many things. So, what are primary and secondary markets effectively? The primary market is where you first purchase the security. Usually a capital corporation helps the issuer or the issuer, meaning it can be a government, it can be a corporate borrower, and they are the ones that issue the security. The capital corporation that helps them and the issuer, this is the primary market. Getting it from the capital corporation or from the issuer themselves, that is the primary market. If you are buying and selling in the secondary market, meaning for equities in the Philippines, it's most likely the Philippine Stock Exchange. And for bonds, it's the Philippine Dealing Exchange or PDEX. And banks and individuals buy and sell from these. These are examples of the secondary market. So let us define cash and money market instruments. What is cash? Well, effectively, they give you low returns, but the certainty of getting the money back, meaning if it's a time deposit, assuming the bank doesn't default, you get the cash plus the interest, and there is a high certainty that you will get the money. This is considered to be generally the safest because it is the least risky, but it can only give limited earnings. It is not completely safe, but because it may lose value from increasing prices of goods, which is the definition of inflation. What are the things that can be considered as cash? The money that you have in your person, current account, savings account, your time deposits, your money market investments, treasury bills, which are short-term investments less than a year, and right now the BSP bills, and bonds that are nearing maturity that have a less uh, that have their maturities within 1 year or less. What is fixed income, ladies and gentlemen? Fixed income, on the other hand, what are the basics? It's an instrument that allows governments, companies, and other types of issuers to borrow money from investors. So, it allows governments and companies to lend them money and they can use the money to expand their business, grow their business, or pay off their old debts. What are the major characteristics of fixed income securities? They have no ownership rights, right? They are just lending their money. So they are not like equity holders that have ownership. They have no ownership rights. And fixed income securities take precedence over payment to shareholders or equity holders upon bankruptcy. So in theory, fixed income investments are less risky than investing in common shares or stocks. Compared to money market, investments in fixed income are used to generate higher and steady income. So what are bonds? When you define fixed income, what are bonds? A bond is basically a debtor loan. So when a government issues bonds, for example, they are basically borrowing money. Those who buy government bonds serve as the lenders are paid with interest. How they earn? They earn through coupon payments and through price appreciation or capital gains. So what are examples of bonds? These are government securities, retail treasury bonds, fixed rate treasury notes, dollar bonds, treasury bills, and corporate bonds. And of course, under this are also loans Some may include promissory notes. Why do we invest in bonds? Well, you want the steady stream of coupon payments, and the returns may be slow, but they are predictable, and we like slow and predictable. Who are the counterparties that you deal with when issuing bonds? So the issuer is the entity who's offering the bonds for sale to investors. So most often than not, these are governments and corporations. They are the ones who are responsible for paying uh, the coupons or the interest, or making sure that the investment contract is fulfilled. The term which the date and time during which the date is that the term is the date and time during which the debt instrument is outstanding. Maturity is when the debt becomes due for payment. And the principal is the amount to be repaid to the investor at maturity. The coupon, on the other hand, is the periodic interest payment made to the bondholder during the life of the bond. So obviously the coupon here, if you look at it, if you invest 100 and the coupon is 5%, having invested 100, shown here by having a negative 100, you pay 5, which is 5% times 100 over the next 5 years. You know, this is an example of a bond that pays annual interest or annual coupons. So you get 5% for the next 5 years, and on the fifth year, you get your principal back plus the last coupon or the last interest payment. Bond prices and interest rates are inversely correlated. So you have to remember this, ladies and gentlemen. So when interest rates go down, bond prices increase. And conversely, when interest rates rise, bond prices fall. So just as a quick reminder, ladies and gentlemen, when interest rates fall, bond prices rise. So a situation in the market where interest moved from 10% to 9%, what happens is bond prices move up. Okay. When interest rates rise, on the other hand, let's say from 9% to 10%, bond prices fall. What are other examples of bonds? A zero bond does not pay periodic coupon interest payments. Bondholders receive the face value of the bond and the interest of the bond when it reaches maturity. Case in point, the face value here is 1 million pesos, and the settlement amount or the amount that you put in is 900. At the end of it all, at the end of the term, you get 1 million pesos back. The 100,000 pesos is effectively the income that the investor gets when they're investing in the zero bond. The regular bond, on the other hand, pays coupon interest to bondholders until maturity. And as mentioned earlier, on maturity, the bondholders receive the face value and the last coupon payment. So to continue, when the bond is issued at cost, that's usually what happens when a bond is first issued. A bondholder pays at cost. So if the face value of the bond is 1 million pesos, effectively, the buyer of the bond or the bondholder will pay 1 million for the purchase of the bond. So assuming that the face value of the bond is 1 million pesos, the tenor is 5 years, and the coupon is 5% per annum, which has quarterly payments, the bondholder again pays 1 million for the purchase of the bond, and the bondholder receives a coupon interest every quarter for 12,500 or 10,000 net of 20% final withholding tax. If the bond is purchased at a discount, well, effectively, it's a bond that is currently trading for less than its par value in the secondary market and is a discount bond. So if it's purchased at a discount, it effectively offers a coupon rate that is lower than the prevailing interest rate. That's the main reason why the coupon, why the bond is being sold at a discount. So If a bond, on the other hand, is purchased at the premium, the bond is trading above its par value or its original price in the secondary market. So it, in fact, is a premium bond. So a bond will trade at a premium when it offers a coupon rate that is higher than the current prevailing interest rates being offered for new bonds. So this is because the investors are effectively willing to pay more for the bond's higher yield. So what are the other elements of bonds? So there is the yield to maturity. The yield to maturity is effectively the compounded rate of return of a security until maturity. Effectively, it's also the discount rate at which the sum of all future cash flows from the bonds, which includes the coupons and the payment of the principal, is equal to the price of the bond. So if you look at it from a numerical standpoint, the price of the bond is the summation of the coupons divided by 1 plus the discount rate raised to the period when it is being paid out. And then you add that all up. If it's 5 years, then you have five of these, plus the final maturity value and the time period when the payment is to be received. One thing we need to remember is that fixed income instruments usually move against equities. The exception to this trend happens when investors have a bullish outlook on the economy, while others have a bearish outlook. Usually, fixed income instruments are used to hedge against certain types of risks. By diversifying investments into stocks and fixed income, investors can, in fact, diversify away certain risks because of their low correlation. So these government securities, one thing we need to remember, are risk-free. They can actually reduce a portfolio's volatility while maintaining relatively the same expected return in comparison to that of a less diversified portfolio. So moving right along, let's talk about bond ratings. So what are bond ratings? A bond rating is an evaluation of the creditworthiness of a bond issuer. This is a corporation or a government and an indication of the likelihood that the issuer will be able to meet its obligations, including interest payments and principal repayments. Bond ratings are assigned by credit rating agencies and help investors assess the level of risk associated with a particular bond. The higher the bond's rating, the lower the interest rate it will usually carry due to the lower risk, all else being equal. The bond rating agencies rate all types of bonds, from corporate bonds to sovereign bonds. Most of the bonds carry ratings provided by at least one of the following three chief independent international rating agencies. This is Standard & Poor's or S&P, Moody's Investor Service, or we call them Moody's for short, and Fitch Ratings Inc., or Fitch. So for investment grade securities or long-term instruments, the ratings lie on the spectrum ranging from the highest credit quality on one end to default or junk on the other. So for Fitch, a triple capital A rating, to be clear, is the highest, and the lowest is BBB minus with regards to an investment grade score. For Moody's, on the other hand, a triple A rating or a AAA rating with a capital A and two smaller A's rating is the highest, and the lowest for an investment grade rating is a Baa3. For S&P or Standard & Poor's, the triple A rating, capital A rating, three capital A rating is the highest, and the lowest is a BBB minus in the investment grade score, or a capital B, capital B, capital B. Let's move along to equities. So effectively, equity, shares, or a stock is a type of security that signifies ownership in a corporation. It represents a claim on part of the corporation's assets and earnings. So, what are equities? They're also known as shares or stocks of a company. If you have equities, if you own shares, you own a certain percentage of the company. So, gains from equities are primarily from stock appreciation, although some stocks may give regular income in the form of dividends. In comparison to fixed income, they have a higher long run average returns, but very high year-to-year volatility. So there is some uncertainty. And of course, there is some unpredictability with regard to the cash flow. So what does it imply when you own stocks? You are a part owner of a company. As a part owner, you will in fact take part of the company's profits and loss, and you may vote on certain issues, particularly the major ones. And you may be part in the election of the board of directors. So when you analyze equities, you look at profitability. Is the company making money? How well is it making money? Can you compare it versus the other similar industries around or the other companies around? Is this profitability sustainable or is it a one-off? As mentioned, how is it compared to similar companies? And how about the asset base? Does the company, in fact, have what it takes to stay in the business? Does the company have what it takes to operate profitably and grow further? So this also includes human resources. Do they have a wise and prudent board of directors? Do they have effective management and happy employees? So when you're analyzing equities, at least in the Philippines, the Philippine Stock Exchange Index, it's the most common benchmark used for investment stocks listed in the PSE. So alternative assets, on the other hand, these include derivatives, real estate, art, commodities, jewelry, and also venture capital. So note, these are expressly prohibited under UITF regulations. So as part of alternative assets, derivatives are defined as securities that derive or base their value dependent on the value of another security. So these include options. So these options give the holder the right but not the obligation to buy or sell a security at a specified price in the future or at a certain point in time. Forwards and futures are also under derivatives. They fix or guarantee the price of a security for future transaction. It applies to a security price, interest rate, or foreign exchange. And of course, a swap or a series of forwards. So derivatives can be used for hedging, such as the put option. A put option, by definition, is the option of the investor to sell to the issuer at a specified price and date or period in the future. An interest rate floor, on the other hand, is a lower limit to the downward adjustments in coupon rates for floating rate bonds or notes. So if you have a floating rate note that moves with, let's say, the 91-day T-bill rate, and you have a floor. So the T-bill rate can move up from 1 to 2 to 3 and 4 and move down likewise to below 1. But if you have a floor at 1%, even if interest rates or the reference rate, let's say in this case, the T-bill rate, drops to less than 1%, since your floor is at 1%, you will not receive interest or you will not pay interest lower than 1%. Step-up rates, on the other hand, are automatic adjustments of coupon rates if the bond is not redeemed on a certain date. So if a bond or a preferred share is not redeemed at a certain date, the step-up rate can move the dividend payment or the interest payment higher by 1 or 2 or 3%, depending on the agreement. So in comparison, if you look at the three asset classes that we discussed, in terms of risk, cash has comparatively low risk, whereas bonds have medium risk, because they also have price risk, whereas equities have the highest risk among the three. For cash, as mentioned, they have the lowest returns among the three, Bonds comparatively have medium returns, whereas equities have the highest returns, possibly the highest returns, to be clear. Cash, it's quite improbable to beat inflation, whereas for bonds, it is probable to beat inflation, whereas for equities, at least for the long term, it is the most probable to beat inflation. How these earn? For cash, it's interest on the deposits that you invest. For bonds, there are coupon payments, and of course, this also includes price appreciation. For equities, it earns through price appreciation and dividends of the stock. So let me just define the different types of risks. So we'll define each in the later slides. You have credit risk, counterparty risk, liquidity risk, interest rate risk, market risk, sovereign risk, currency risk, reinvestment risk, and shortfall risk. Let's start with credit risk. So credit risk is the risk that comes from the possibility that a borrower fails to repay his loans or meet a contractual obligation. Counterparty risk, on the other hand, is the possibility for the fund to be exposed to risk related to the credit standing of its counterparties and their ability to fulfill the conditions of the contracts it enters into them. For liquidity risk, it is the risk that your investment effectively cannot be immediately converted into cash. Interest rate risk, on the other hand, is the risk that comes from fluctuating interest rates of bonds. So the actual price of a bond could potentially be affected by changes in interest rates. Remember, as rates go up, bond prices go down and vice versa. Market risk, on the other hand, is the risk that comes from changes in the prices of assets due to events that affect the overall market. An event that may affect the overall market is a recession. Country or sovereign risk, it's the risk that comes from a collection of risks that affect the foreign currency you're invested in. The collection of risks include political risk, FX risk, economic risk, sovereign risk, or transfer risk. This risk varies from country to country. Currency or foreign exchange risk is the risk that comes from investments losing value because of the changes in currency rates. Usually, this affects businesses that import or export goods or investors that make international investments. Reinvestment risk, the risk that comes from lower available interest rates. After a previously owned bond with a higher interest rate matures, you cannot find rates that are as good as you had before or as high as you had before. So shortfall risk is the risk that an investment's actual return will be less than expected or required return. So this leads to one failing to meet a financial goal, like retirement funding, a tuition payment, or a debt repayment. So there is an additional risk for feeder funds and fund of funds. These risks are comprehensively explained in the regular updates and official documents of the target funds underlying these UITFs. So understand one thing that we have to remember is the power of diversification. There is not a single product that addresses all of these needs simultaneously, but several investment products can be packaged together to achieve the required results. So a combination. So the diversification is the process of allocating investments in a way that reduces the exposure to any one particular asset or risk. It aims to maximize returns by investing in multiple assets that would each react differently to the same event. So what is the importance of diversification? It minimizes the risk of loss. it reduces volatility, and it maximizes potential returns. So, portfolio management is a systematic combination of investment instruments to produce an optimal combination of liquidity, returns, risk, and the basic principle of modern portfolio theory, or MPT, is that through diversification, investors achieve higher returns for the same level of risk and the same return for a lower level of risk. So you utilize things such as horizon matching when you consider when you need the cash, or cash flow matching, and goals-based investing, wherein you take into consideration the intentions. So just to remind you what the liquidation hierarchy is, it actually refers to the process of bringing a business to an end and distributing its assets to claimants. This process can be initiated voluntarily by the company or forced by its creditors due to insolvency. There is a structured order of priority that outlines who gets paid first and who might receive little to nothing during a company's liquidation. This hierarchy ensures that an organized and fair distribution of assets, minimizing disputes and legal complications. So, what is the breakdown of the typical order of payment in liquidation? First one is the secured creditors. They have the highest priority in the liquidation hierarchy. They have collateral backing their loans and have legal claims to specific assets if the debtor defaults. These include banks or financial institutions with mortgages or liens on property or equipment. There's also unsecured creditors. They're the second in the hierarchy. So they do not have specific assets backing their loans. They make their claims riskier. They include suppliers, contractors, and bondholders without collateral. Three, you have the subordinated debt holders. So meaning they are paid only after higher ranking creditors have been satisfied. And you have subordinated debt typically carries higher interest rates to compensate for this increased risk. So for preferred shareholders, they all have a higher claim on assets than common shareholders, but are subordinate to all types of creditors. They often receive fixed dividends and have priority over common shareholders in asset distribution, but they generally lack voting rights. And last but definitely not the least, these are the common shareholders. They are the bottom of the liquidation hierarchy, and they are the last to receive any remaining assets after all higher priority claims have been satisfied. And they often face significant losses or receive nothing. So that's the end of Module 1. Let's now proceed to Module 2.